Welcome back to Market Insights, where we dive deep into the latest financial news shaping our world. I'm your host, Naim. Today we're unpacking a lot of significant developments, starting with the recent global sell-off in AI-driven stocks. Joining me today is our financial expert. Thanks for being here.
Thanks for having me. It's great to be back, especially with so much happening in the markets.
Absolutely. So let's get right into it. Over the past few weeks, we've witnessed a sharp downturn in AI-related stocks. According to recent data, the tech-heavy Nasdaq has dropped nearly 10% since the peak earlier this summer. What do you think is driving this sell-off?
Well, it's a combination of factors. First, we saw an initial excitement around AI stocks earlier this year. But as investors started to analyze earnings reports, many companies failed to deliver on those high expectations. For instance, companies like Nvidia and Alphabet saw their stock prices tumble after disappointing guidance.
That's true. Nvidia, which was a darling of the market, saw its shares drop about 20% in just a few weeks. Do you think this trend is indicative of a broader market correction, or is it more specific to the AI sector?
It seems to be a mix of both. The excitement around AI created a bubble, and as interest rates rise and inflation concerns linger, investors are getting more cautious. When you couple that with the volatility in the tech sector, it's no surprise we're seeing this sell-off.
Speaking of caution, major funds and institutions are shifting their investment strategies in response to this uncertainty. Can you shed some light on what changes we're seeing from these players?
Certainly. Many institutional investors are reallocating their portfolios. For example, BlackRock recently mentioned they are diversifying away from tech-heavy investments and focusing more on defensive sectors like healthcare and consumer staples. This shift is a strategic move to hedge against potential downturns.
Interesting. So they're prioritizing stability over growth right now. With this shift, do you think we might see a resurgence in sectors that had been overlooked during the AI boom?
Absolutely. Sectors like energy and utilities, which are often considered safe havens, may gain traction. Additionally, with the global push for sustainability, green energy companies could also see renewed interest. Investors are searching for reliable returns in uncertain times.
Switching gears a bit, let's dive into some geopolitical developments. The peace talks in Ukraine have been gaining traction recently. How do you think this impacts the global market landscape?
The peace talks are crucial. If a resolution is reached, we could see a stabilization in energy prices, which have been quite volatile due to the ongoing conflict. Moreover, a peaceful resolution would likely improve investor sentiment towards Eastern Europe, which has been under significant stress.
That makes sense. The conflict has undoubtedly influenced global energy markets. We have seen European gas prices fluctuate drastically. If peace is achieved, do you think we could see a significant drop in these prices?
Definitely. A cessation of hostilities would likely lead to increased supply and lower prices, benefiting not just European economies but also those in Asia that rely on energy imports. However, the timeline for peace remains uncertain, and markets will stay jittery until then.
And while we're discussing corporations in the tech sector, Foxconn has made headlines with its own AI initiatives. What can you tell us about their moves in this area?
Foxconn is expanding its presence in AI by investing heavily in automation and smart manufacturing technologies. They're aiming to enhance productivity, especially in their factories. This might also be a strategic play to counterbalance labor shortages and rising wages in countries like China.
It's fascinating how companies are leveraging AI to adapt to current challenges. Do you think Foxconn's shift could set a precedent for other manufacturing giants?
Absolutely. As companies face increasing pressure from labor costs and supply chain disruptions, adopting advanced technologies like AI could be the key to maintaining competitiveness. We might see a broader trend where traditional industries embrace digital transformation.
Now, let's touch on Evergrande, which continues to face significant challenges. The real estate giant has been in the news for its ongoing financial struggles. How do you see this impacting the broader real estate market in China?
Evergrande's troubles have already had a ripple effect in the Chinese real estate market. With their debts in the hundreds of billions, the fear of defaults has led to decreased investor confidence. This could slow down new projects and exacerbate the housing crisis in China.
And with the Chinese government taking measures to stabilize the situation, do you think these efforts will be effective in the long run?
The government has already implemented policies to ease liquidity constraints for other developers. But the long-term effectiveness will depend on how swiftly they can manage Evergrande's debts and restore confidence in the market. It's a delicate balancing act.
That's a great point. As we wrap up, let's discuss what investors should keep in mind moving forward. Given the current landscape, what would be your key advice?
My main advice would be to stay diversified and keep an eye on geopolitical developments. With markets reacting to news from Ukraine and corporate shifts like those from Foxconn, being agile and informed is key. It's essential to have a well-thought-out strategy that can adapt to changing conditions.
Great insights. It's always important to stay proactive in this ever-evolving market. As we conclude our discussion, I encourage our listeners to stay informed and consider their investment strategies carefully.
Absolutely. And remember, seeking advice from financial professionals can help tailor your approach based on your individual risk tolerance and goals.
Thank you so much for joining us today. It's always a pleasure to have you with us.
Thanks for having me. I look forward to our next discussion.
And thank you all for tuning in to Market Insights. Make sure to subscribe and stay updated on the latest trends and news shaping the financial landscape. Until next time, take care.